screaming stock rallies and crazy speculation by admirable amateur investors raised concerns among market veterans about a bubble that could rival anything seen in the last century. Following a dramatic recovery from the coronavirus crash last March, benchmark stock indices dropped a series of records in the early days of 2021. Popular stocks like Tesla continue to challenge conservative valuation efforts. Seth Klarman, founder of Baupost Group, warned investors that they were under the wrong impression that the risk in the markets simply disappeared, likening them to slowly boiling frogs. GMO co-founder Jeremy Grantham has described the rally as an epic bubble characterized by overvaluation since 2009. Fund managers are on the lookout for a withdrawal. It's hard to time the end of this form. It may take longer than you think. I do not see any big movement below, but we have gotten more cautious, said David Alder, Carmignac's head of stock. But with markets hovering on an unprecedented wave of monetary and financial support, bond yields nailed to historic lows and investors, both institutional and retail, sit on excess cash stacks, while the strange patterns in the stock markets may continue for a while. In a note released in mid-January, analysts at Absolute Strategy Research drafted a checklist of bubble indicators that set the current rally in United States growth stocks in conjunction with the boom and decline in Japanese stocks in the 1980s and the decline in dot-com stocks in the late 1990s and the long round trip in commodity stocks in the first decade of the 2000s. Common features include low interest rates, over-earning stock valuations, out-of-control retail business, and rapid accelerations in equity gains. At all these points, the current market conditions seem alarming. ASR points out that over 10% of stocks in the US blue chip S&P 500 benchmark are 40% or more above their averages over the past 200 days, an event that has only been seen 4 times in the past 35 years. Customers are increasingly worried, said Ian Hartnett, co-founder of ASR. However, if interest rates remained low and fund managers felt pressured to jump on the bandwagon, the rallies could have just started. There is career risk in the fearing of losing, he said. People find a way to rationalize every bubble. They need to explain to a chief investment officer or an investment committee why they have been working here for a long time. Some point to the boom in the trade of inexperienced amateurs as a particular concern, seen as weak hands by professional fund managers, intolerant of losses, and seen as quick exit bets. These investors are on the rise as the shortage of lock-ins spurs them into commission-free trading offered by startups like Robinhood. Mr. Alder of Carmignac said Americans in the United States are starting to turn to stocks as casinos, and many sports are closed. He stated that most of his investments are focused on hypergrowth shares, such as electric vehicle manufacturers. There is no valuation ceiling for these companies, he said. However, even considering all these warning signs, investors are not running towards exits. This is partly because the increase in retail trade may be less disturbing than it appears. Unlike previous episodes of high-profile retail enthusiasm, analysts and fund managers suspect the current crisis could be more robust and unlikely to survive households with large losses. It's important to remember how retail investors are financing these purchases, said Salman Beg, multi-asset investor manager at Unigestion in Geneva, drawing a contrast to events such as China's 2015 bubble, where a rise in margin finance sent stocks soaring before a brutal crash. Now, household savings are high, he added. People created cash balances. It does not feel like a balloon to us. Rather, there are some expensive stocks where a meaningful correction can be made. Optimists also stress that professional investors do not take the same determined attitude to risk-taking instead. They continue to take measures against the risk of the market recession. Reflecting on hedging against sharp movements in the US stock markets, the VIX Volatility Index stands above 23 points compared to the long-term average just below 20. It was 14 points at the beginning of last year. The fact that people are still nervous enough about future volatility shows that people are not entirely involved, said Andrew Sheets, Chief Cross-Being Strategist at Morgan Stanley. The repercussions are strong with previous forerunners of jolts on the market. But apart from an almost unimaginable retreat of support from central banks or an inflation boom that seriously shocked the bond market, many investors agree that it is hard to imagine what could trigger a massive return on risky assets. I don't think bubble bugs acknowledge why stocks are so expensive, said Michael Kelly, head of multi-wealth investment at Pine Bridge Investments. In 2021, the markets are rising because earnings are increasing and excess liquidity is still rising. We're in the structural growth in capital due to the rising rate of savings and additional quantitative expansion. We have never experienced this before. He believes it will take at least 10 years for this to resolve. Right now, there's quite a lot of concern that the stock market is in a bubble. Personally, I do not think the whole stock market is in a bubble. However, I believe some market areas such as the US tech sector are currently overly tense. Let us look at some bubble indicators that concerns me. Valuations are excessive. Speaking of valuations, some technical assessments seem too high to me. Take Tesla for example. The market value is currently about $800 billion, which equates to a value of about $1.6 million per car sold. He may be right in the long run, but it just not make sense to me. Bubble indicator. Finally, if we take a closer look at the tech industry, it is worth noting that Polar Capital Global Technology, one of the UK's largest global tech funds, closed itself to new investors last year due to the enormous demand for technology stocks. After assets under management rose from £2.9 million in March to £4.5 billion in June, Polar Capital announced that the fund was slowly closing. I see this as an outlier bubble indicator. Stock market bubble. What am I doing right now? Given these bubble indicators, I think it is worth focusing on risk management right now. Here's what I do to protect my portfolio. First, I closely monitor my exposure to expensive growth stocks. I do not want my portfolio to be excessively exposed to these type of stocks. Second, I make sure my portfolio is well balanced. Lately, I have been increasing my exposure to more defensive names like Unilever and Pencasa. If the stock market falls, these stocks will hopefully provide protection. I'm finally saving cash. This will give me the firepower to buy large stocks at good prices if the market pulls back soon. I see the signs of the post-stock market bubble. If you make any investment or legal decision, it is advised to consult an expert before making this decision.